This week, the market revealed something profound about human nature and exploitable patterns. While everyone focused on record highs and earnings beats, the real story was unfolding in the psychology of participants caught between euphoria and anxiety. Microsoft plunged over 10% despite massive AI spending, Meta surged 9% on guidance, and gold hit new all-time highs above $5,500. These aren't random events. They're predictable consequences of how humans respond to uncertainty. The crowd entered Monday riding momentum from 4 straight days of gains, but beneath the surface lay a fragile consensus built on one dangerous assumption, that AI infrastructure spending would automatically translate into earnings growth. This assumption shattered when Microsoft reported slowing cloud growth despite record capital expenditures. The cognitive dissonance was immediate. Investors had been conditioned to accept massive AI spending as necessary for future dominance, but suddenly the marginal utility of each additional dollar became visible. Fear of missing out transformed into fear of being trapped. The herd recognized that capital intensity without proportional revenue acceleration creates a valuation trap, not a competitive moat. This uncertainty paralyzed decision-making, manifesting as Thursday's tech sell-off and flight to industrials like Caterpillar, which gained over 4%. The Federal Reserve's pause at 3.75% reinforced a different psychological dynamic, the illusion of control. 2 governors dissented, advocating for cuts, which introduced doubt about Fed cohesion. When the referee's impartiality is questioned, players adjust defensively. The result was a measurable shift toward assets perceived as independent of policy discretion. Gold, silver, and mining stocks surged as participants sought stores of value insulated from institutional uncertainty. Now here's where the system layer becomes exploitable. The market structure exhibited classic signs of regime transition. Monday's advance showed the Dow declining while the S&P and Nasdaq rallied, rotation, not broad-based strength. By Tuesday, the S&P reached new highs, but breadth indicators showed deterioration. Fewer stocks participated even as the index climbed. This divergence created a mechanical setup for reversal once a catalyst emerged. Wednesday's earnings provided that catalyst. Algorithmic trading systems recalibrated risk parameters overnight, leading to concentrated selling in mega-cap technology, while the Dow remained stable due to lower AI exposure. The Nasdaq's decline was valuation-driven, not macro-driven, a crucial distinction for positioning. Gold's surge above 5,500 represented a technical breakout from months of consolidation. The move was driven by dollar weakness, compressed real yields, and geopolitical risk premium. Thursday's pullback on Fed chair speculation was noise, not signal. The underlying structure remained intact, supported by central bank demand and structural supply constraints. The healthcare sector's collapse following Medicare rate announcements demonstrated how policy-driven repricing gets amplified by options dynamics. United Health's 19% decline created feedback loops that extended selling beyond what the policy change alone justified. This contagion pattern is exploitable when you understand the mechanical forces at play. The Stoic approach recognizes these patterns as inevitable, not surprising. When capital expenditures grow faster than revenue, and markets ignore this divergence in favor of narrative, repricing becomes a question of when, not if. The catalyst is irrelevant. The structure was already fragile. This earnings season revealed markets moving beyond simple beats to focus on sustainability and capital efficiency. Companies spending heavily without demonstrating proportional returns face punishment regardless of narrative appeal. IBM and Caterpillar exemplified efficient capital deployment and rallied. Microsoft exemplified the opposite and sold off despite beating estimates. The government shutdown threat reminds us that political dysfunction is constant, not anomalous. Assets with intrinsic value, low leverage, and global demand profiles remain resilient. Assets dependent on policy stability or domestic consumption become vulnerable. The distinction is clear to disciplined observers. This week's volatility wasn't deviation from normalcy, but return to it. Preceding months of low volatility created complacency, and complacency always precedes repricing. The disciplined exploiter doesn't fear volatility but welcomes it as opportunity to exploit gaps between price and value. The lesson is that markets are predictably irrational short-term and predictably rational long-term. The path forward isn't predicting the next catalyst, but positioning for inevitable convergence of price and value, knowing the market eventually reflects reality regardless of timeline. History shows humans consistently oscillate between greed and fear, creating exploitable patterns for those who observe without attachment. If you value systematic thinking over emotional noise, subscribe for frameworks that exploit human predictability. The complete system is available in the description. Download the guide that turns market psychology into disciplined advantage.